Hello everyone, welcome to my channel. Today I'm going to talk about double entry bookkeeping explained. Let's get into the video. Double entry bookkeeping is the backbone of modern accounting systems. Unlike single entry bookkeeping, which records financial transactions only once, double entry bookkeeping records transactions in two accounts, ensuring that every transaction affects both a debit and a credit. This system ensures accuracy, reduces errors, and provides a clear financial picture for businesses of all sizes. In this video, I will go over the key concepts behind double entry bookkeeping, how it works, why is it essential, and practical examples to solidify your understanding. The basis of double entry bookkeeping. At its own core, double entry bookkeeping is built on the accounting equation assets equal liabilities plus equity. This equation reflects the fact that everything a company owns, which is the assets, is either financed by borrowing liabilities or by owner investments, equity. For each transaction in double entry bookkeeping, two entries are made, one to record the inflow or outflow of an asset, liability, or equity, and another to maintain the balance of the accounting equation. The key components, debits and credits. To understand double entry bookkeeping, one must grasp the concept of debits and credits. Every financial transaction impacts at least two accounts, and the total amount of debit must equal the total amount of credits for each transaction. This balance system is what keeps the books in harmony. Debits, which is DR, represent an increase in assets or expenses and a decrease in liabilities or equity. Debits are recorded on the left side of a ledger. Credits, which is CR, represents a decrease in assets or expenses, an increase in liabilities or equity. Credits are recorded on the right side of a ledger. For every transaction, the sum of the debits must always equal the sum of the credits, maintaining the balance of the accounting equation. The charts of accounts. Before entering transactions, a company must set up a chart of account. This chart is a list of all the accounts a company uses to track financial transactions. Common categories in the charts of account include assets, which is resources owned by the company, such as cash, inventory, accounts receivable, and equipment. Liabilities, obligations the company owes, such as loans, accounts payable, and mortgages. Equity, the owner's interest in the company, including retained earnings and capital. Revenue, income earned from selling goods or services. Expenses, costs incurred by the company in its operations, such as rent, salaries, and utilities. Each account is assigned a unique account number for easier tracking. For example, an asset account might start with a 1, liability with a 2, and so on. How double entry accounting works, the process. Step 1, identifying transactions. The first step in double entry bookkeeping is identifying financial transactions. A transaction is any event that has a monetary impact on the financial position of a business. Examples include purchasing inventory, receiving payments from customers, or paying salaries to employees. Step 2, determine the accounts affected. Once a transaction is identified, the next step is determine which accounts are impacted. For every transaction, there must be at least two affected accounts. For example, when a company buys equipment, it affects both the cash and equipment accounts. Step 3, applying the debit and credit rule. After identifying the accounts affected, the next step is determining which account to debit and which account to credit. The general rules for debits and credits are as follows. Assets, debits increase assets, credit decrease them. Liabilities, debits decrease liabilities, credits increase them. Equity, debits decrease equity, credits increase it. Revenue, debits decrease revenue, credit increases it. Expenses, debit increase expenses, credit decreases them. Step 4, recording the transaction. With the accounts and the debit and credit rule in mind, the transaction is recorded in the company's general journal. The general journal is where all transactions are initially entered, showing both the debit and credit side of each transaction. The journal entry should include the date of the transaction, the accounts affected, the amounts debited and credited, a brief description or explanation of the transaction. For example, if a company buys $1,000 worth of office supplies on credit, the journal entry would look like office supplies debited for 1,000, accounts payable credited for 1,000. In this case, the company debit the office supplies account, an asset, because it has increased its office supplies. Simultaneously, it credits accounts payable, a liability, because the purchase was made on credit, increasing the company's liabilities. Step 5, posting to the ledger. After recording the transaction in the general journal, the next step is posting it to the general ledger. The general ledger is where each account's transactions are tracked individually. Each account, such as cash, office supplies, or accounts payable, has its own section in the ledger, showing the debits and credits over time. Continuing with the example I just spoke about the debit to the office supply and the credit to the accounts payable are posted to their respective ledger accounts. Over time, the ledger provides a detailed record of all transactions affecting each account. Step 6, trial balance. Once all transactions for the accounting period have been posted, a trial balance is prepared. The trial balance is a list of all accounts and their ending balances, with debits on one side and credits on the other. The total of all debit balances must equal the total of all credit balances. If the trial balance does not balance, it indicates an error in the bookkeeping process, which needs to be corrected before moving on. Step 7. Financial statements. Once the trial balance is accurate, the data is used to prepare the company's financial statements, including the income statement, balance sheet, and cash flow statement. These statements provide insight into the company's financial health and are essential for stakeholders, including investors, creditors, and management. Advantages of double entry bookkeeping. Double entry bookkeeping offers several advantages that makes it the preferred method of accounting for businesses of all sizes. Some of the key benefits include: 1. Accuracy and error detection. The requirement that debits must equals credits ensures that every transaction is accounted for properly. If the debits and credits do not balance, it signals an error that needs to be fixed. This systematic approach helps reduce mistakes and improves the overall accuracy of financial records. Second thing is complete financial picture. Double entry bookkeeping provides a comprehensive view of a company's financial position by recording both the inflows and outflows of assets, liabilities, and equity. This holistic approach allows businesses to track not only where their money is going, but also how different transactions impact their overall financial health. The third one is facilitates financial reporting. Because double entry bookkeeping adheres to a standardized format, it simplifies the process of creating financial statements. These financial reports, including the balance sheet, income statement, and cash flow statements, are essential for making informed business decisions, securing financing, and meeting regulatory requirements. Next thing is improve financial control. Double entry bookkeeping helps business maintain better control over their finances. By tracking revenues, expenses, assets, and liabilities accurately, companies can monitor their cash flow, budget more effectively, and identify potential financial problems early on. Compliance with accounting standards. Double entry bookkeeping is required under general accepted accounting principles, better known as GAAP, and International Financial Reporting Standards (IFRS). These standards ensure consistency and transparency in financial reporting, make it, making it easier for businesses to comply with regulations and auditors to assess their financial records. Examples of double entry bookkeeping in a nutshell. Let's say, for example, selling goods for cash. A business sells 500 worth of goods to a customer who pays in cash. The journal entry would be debit cash, credit sales revenue for 500. And as I said, you debit cash for the same 500. In that case, cash is an asset, is debited because the company has received money. which is the asset. At the same time, sales revenue and equity account is credited as the company has earned income from the sale. Second example, let's say paying rent. A company pays $2,000 in rent for its office space. The journal entry would be debit rent expense for $2,000 and credit cash for the same $2,000. Here, rent expense, which is an expense, is debited because the company incurs a cost. Cash, an asset, is credited because the company has paid out cash. For example, purchasing equipment on credit. A company buys $10,000 worth of equipment on credit. The journal entry would be debit equipment for 10,000 and credit accounts payable for 10,000. Equipment, an asset, is debited because the company now owns the equipment. Accounts payable, which is a liability, is credited because the company owes money for the equipment. Challenges and limitations of double entry bookkeeping. While double entry bookkeeping has many benefits, it's not without its challenges. Complexity for small businesses or those without dedicated accounting staff, double entry bookkeeping can seem complicated. It requires more time and expertise compared to single entry system, especially for those unfamiliar with accounting principles. Training. Employees handling double entry bookkeeping need to be well trained to ensure accuracy. Mistakes can lead to unbalanced books and incorrect financial statements, which can have serious consequences. Technology dependency. Although accounting software has made double entry bookkeeping easier, relying on technology introduces potential risks related to system failures, data breaches, or software bugs. In conclusion, I would say double entry bookkeeping is the foundation of accurate and reliable financial accounting. By recording each transaction in two accounts, it ensures the integrity of the accounting equation and provides a complete view of a company's financial position. While it may seem complex at first, mastering double entry bookkeeping is essential for any business looking to grow, maintain financial control, and comply with legal and regulatory standards. From small businesses to large corporations, double entry bookkeeping offers unparalleled advantages in terms of accuracy, transparency, and financial management. By understanding its principles and applying them consistently, businesses can make informed decisions, secure financing, and achieve long-term success. Thanks for watching this video, and do not forget to subscribe to my channel.